Hello, everyone. Welcome back to an episode of Financial Freedom, where we look at real life financial data and turn it into insights. I'm your host, Mario Lazaridis, and today I have a team of data analysts joining me to talk about their data regarding 10 companies. They have chose to talk to us about Barclay Notice in particular, and they're using data from Yahoo Finance along with awards from our French from the year 1989 all the way to the years of 2024. Without further ado, let's get right into it with our first team member here, highlighting the two stocks.
Yes. So our group decided to highlight BCS because it produced one of the most interesting regression outcomes. The regression showed a beta of about 1.37 and an R square of roughly 0.29. These values stood out to us because they show moderate market sensitivity below explanatory power from the market. A beta of 1.37 means that BCS moves about 37% more than the market, so it still responds to the overall market trends, but not in an extreme way. Compared with other financial stocks, its performance is more consistent and less erratic, showing that BCS is relatively steady and predictable. The R square value of 0.29 tells us that the market returns explain less than one-third of BCS performance. That's considered a little, suggesting that the company's specific factors, such as changes in banking regulations or international lending conditions, play a larger role in the market itself. BCS appears defensive and steady because even though it reacts to the market, most of its variations comes from internal or industry factors rather than broad market volatility. BCS has some unusual in here as the combination of a moderate to high beta and a low R square means that BCS still follows market direction but is less dominated by it. Go to the next one. Our second stock that we analyzed was Otis Worldwide, and its regressions results were unusual in the opposite way. Otis showed a very low beta of 0.17 and an R square of around 0.50. But the scatter plot revealed that the fit line was almost vertical, which immediately caught our attention. The beta of a 0.17 suggests Otis should move very little with the market, but the vertical slope in the plot tells us a different story. It indicates that Otis returns change drastically even when the market barely moves, which points to unstable or inconsistent market sensitivity. Rather than being defensive, this pattern shows Otis behaves in a more unpredictable and riskier way than the numbers alone might suggest. The R squared value is about 0.50. The widest scatter of the plots of the points show that the market only partially explains Otis' behavior. Half of its movements align loosely with the market direction, but the rest seems to come from the firm-specific or random influences. The most unusual aspect of Otis is that its beta and R squared don't match what we normally expect. A stock with beta that low shouldn't show such erratic variation. Okay.
Now, let's turn to the equally weighted portfolio of our 10 companies. To make this concrete, I want to highlight two very different cases from our regressions. Barclays, ticker symbol BCS, and Otis, OTIS. Barclays came in with a beta of about 1.7 and an R squared of roughly 0.29. That tells us Barclays is highly sensitive to the market when the market moves. Barclays tends to move even more. But relatively modest, R squared also means that while the market explains some of its returns, there's also a lot of company-specific volatility. In other words, Barclays is a high beta market amplifying stock, but not one that perfectly predicts from market movements alone. Otis, on the other hand, looks completely different. Its beta was only about 0.17 and the R squared was just 0.09. That's extremely low market sensitivity and very little explanatory power for the cap regression. Essentially, Otis's returns are driven far more by company-specific factors in the overall market. For an investor, that means Otis doesn't provide much exposure to the systematic risk, but it also doesn't track the market in a way that easy to model. When we put all 10 stocks together into an equally weighted portfolio, the results smooth out. The portfolio beta comes in close to one, meaning the portfolio also moves one for one with the market. And importantly, the R squared for the portfolio is higher than for either Barclays or Otis individually. That's the power of diversification. The extreme market sensitivity of Barclays and the near independence of Otis balance out each other, leaving us with a portfolio that's more stable and more predictable. So the takeaway is clear. While individual stocks with Barclays and Otis behave very differently, the portfolio averages those differences. For an investor, that means less distinctive risk and a return profile that's much closer to the overall market.
So a question for you, Isaac. Based on all this information, are the stocks safer or is the portfolio safer for investors with the market?
Well, the portfolio is outright safer, but when it comes to individual stocks, that might be riskier or safer. I would say that the riskiest would definitely be Barkley. It has a beta of 1.32, which means that every single time the market's moving, Barkley is going to be swinging, back and forth, and its volatility will be very high. And it's affected much easier to the market as compared to another stock like Pfizer, which has a beta of 0.78, which means that when the market moves, although Pfizer will be moving upwards, it won't be as risky and swinging upwards and downwards. And Barclays wouldn't really be considered a good option. I'd consider that one to be a loser just because of the fact that its risk is just so high, it's not worth it when buying into it alone. But during times of when the market is being successful, I would say that it is for sure a winner. But that's only when it's swinging upwards very high, which doesn't happen too often. But when it comes to the best risk adjusted performer, I would say that Pfizer is there with a 0.78 beta and Otis with a 0.82. This just means that when the market's going up, they are going to go up as well, but they take on less risk. And when you take it on as a whole with the portfolio, you have a third of your stocks which are providing upside with leverage when market rises, which, as I gave an example before, that was Barkley. And then you have another third of your stocks which, when the market's going down, these kind of hold you down and take on low risk. And then the remainder of your stocks, the other third, they go with the market trends and they stay close and they kind of average things out. So although this portfolio doesn't take on too much risk because it's averaged out, I would definitely say that individually the stocks are affected differently by the market and they work together to keep your risk low.
Well, that is certainly very interesting information. Thank you for sharing. Lastly, we're going to move on to Jasmine. What are two big takeaways that we can take? And what should investors understand from this analysis that you guys provided for us today?
Yeah, our group looked at Otis and Barkley. We found that both move with the overall market, but not in the same way. Otis reacts more strongly when the market rises or falls. Otis is usually moves right with it. Barkley moves less with the market and is more affected by what's going on inside the company. Overall, either one beats the market, but they show different levels of risk and movement. An investor should know that Otis is a good choice if they want a stock that follows the market closely. Barkley is a little bit more unpredictable and depends on the company events or banking trends. Either company gives huge returns, so the main focus should be steady performance and managing risk and not chasing big gains.
Wow. Well, thank you so much for your guys' time today. And thank you all for tuning in. We hope to see you again on the next episode of Financial Freedom and have a great day.